Hello traders, and welcome to the lesson 7 for this trading webinar series. And we were sorry for the little delay that we experienced a while ago. There's just some technical difficulties on our end. So before we begin, I would like to invite everyone again to please join our Telegram channel. You may find the link on the description box below. And we will again start on our draw before we start on our webinar. So to begin, we have 17 right answers from our previous webinar. Again, sorry for the little delay earlier. Okay, so because we experienced some technical difficulties, we will um, start right away with our draw so that we can adjust with the time. Okay, so again, we have 17 winners and let's start. Okay, so 5, 4, 3, 2, 1. So there you go. Our winner is number 12. And number 12 is Rahat Khan. So congratulations, Rahat Khan. Please keep in touch with our team. We will reach out to you to credit your $100 on your live trading account. So once again, congratulations to Rahat Khan. All right. So good evening to everyone, especially to my kababayans. And good afternoon, good morning to everyone, wherever you are today. Hello to Shanda, Chandra Hasa Mulya. Hello to Joy Das. Gandang gabi to you as well, Kuripotakmoto. Hello, Bryan Dizon. Good evening to you as well, Josephine Antonio. Hello, Nelly. Hello, Benancio Junior Arenas. Welcome back, sir. Hello to you as well, Jerome Larocco. Good evening to you as well, dodzkie. Hello, Raver Romontoya. Welcome back. Good evening to you as well, God's Time. Welcome back as well. Hello, Home Sweet Home. Welcome back. Hello, Shailendra at 99. Good evening to you as well, Johnny De Vera Mangandi. And good evening to you as well. And thank you for asking again, Dodong Dapiton. How are you as well? Hello, Ayutuk. Hello to you as well, Jerome Larocco. As well as June Kaintik. Gandang gabi to you as well, sir. All right, so let's start with our webinar today. So for today, what we are going to talk about is about the Wyckoff and Elliott Wave theory. So these methodologies in technical analysis is a very good tool for us to add on our chart reading skill for us to be able to know when the trend is about to end. So this could help us identify some fake breakouts. So if you are trading breakouts, so you may want to look for a Wyckoff theory before trading the breakout, because on Wyckoff theory we can expect if the breakout will fail or not. Okay, so to begin, so what we have here is Wyckoff theory or Wyckoff trading is a method of technical analysis that was developed by Richard D. Wyckoff himself in the early 20th century. So this methodology or this strategy existed on the 20th century. And this method is based on the idea that the market prices move in recognizable patterns and that these patterns can be used to make informed trading decisions. So a Wyckoff trading strategy consists of three parts. So the first one is the markdown, which is the downtrend. And then once the downtrend ends, let's say the markdown ends, then the accumulation will begin. So a lot of times accumulation is just a consolidation pattern or a sideways move from the market. Then after the consolidation, the market will create something like spring or a failed breakout. So this is what I am trying to say earlier. Once you saw that the price is on accumulation phase, and then if the price tried to make a continuation to the downside, most of the time this is just a spring or this is just a failed breakout. Then after that, we can see that the price will break its previous high, and this could start the markup or the uptrend. And then once the uptrend ends, let's say the trend or the uptrend is on a matured trend, it's about to end, it's losing its steam, then distribution will come, and again it will come in a form of consolidation or a sideways move. Then again, we will see a spring or a failed breakout. Then the price will continue to make a reversal once this distribution phase has ended. And if we look on a much complex detail for this Wyckoff trading methodology, we can see that we have here some pointers, and Wyckoff trading consists of four phases: phase A, B, C, D, and E, or five phases. Sorry. So on the first phase, phase A, let's say that we are on an uptrend, we are on a preliminary supply. So let's say we have a markup or an uptrend here. Then let's say that after reaching this level, the price reach its preliminary supply. Sorry about that. And then we can see that the price went up, breaking this previous high. So this is the buying climax. So this BC stands for buying climax. Then once the price reach its climax, its peak, we can see that the price will create something like this, a pullback which is longer than the previous pullbacks that we can see on our previous correction move, right? So as you can see, this pullback right here, as well as this pullback right here are short. The first three pullbacks were short, and then after reaching the buying climax, or after the price reach its apex, we can see that the pullback, this next pullback, is deeper than the previous three pullbacks that we have right here. Okay, then after that, we can see that the price is creating a reaction. So let's say that most of the times the price, this pullback, will reach the previous two. If you remember our 1, 2, 3 lesson, so this previous two was tested, and then the price will give us its first lower high. So this buying climax is higher than this new high right here, which is a lower high, right? So this is the start. This is the start of secondary test. ST stands for secondary test. So most of the time, the price will try to retest the buying climax. So again, this buying climax is the highest that the price got into. Then once the price created a deeper pullback, which is a pullback that reaches this previous low that we have right here, or our previous two, we can expect to see a move, a reaction like this. And then after this one, the price will likely to make a breakout from this previous low. And this is a sign of weakness. So SOW stands for sign of weakness. And then if we can see a sign of weakness or a breakout from this previous two that we have right here, then we can expect for the price to make an upthrust move, or this is where we can expect a fake breakout or a failed breakout. So the price, after showing a sign of weakness here below, the price will likely to make another run to the upside, but we can see that the price will just make a failed breakout on the climax or on our peak. Okay, then after we saw that the price is trying to break through from our peak, from our buying climax, then this will be the start of the phase B. Okay, so once the price created the sign of weakness, so this may be the start of the phase B. And then once the price tried to make another breakout to the upside, which is the buying climax or the peak of our price action, then we should just avoid trading from this phase because phase B is just a consolidation phase. And just like what we learned from the past, if the price is just making sideways or if the price is just consolidating, then we should just avoid trading that movement. Okay? Then once the price created an uptrust move, or this is what we call a spring on our slide, as we can see here, this is what we call a spring. So this spring is happening right here, or we can also call it an uptrust. Then once the price went inside the range again, so remember the lesson on the Darvas box. If you remember our previous webinar, I showed you how to draw a Darvas box. So once the price created again a sign of weakness here below, then the price created an uptrust or a spring. The price will likely to make another pullback inside our Darvas box, and then the price will try to make its last push to the upside, which is the UTAD or the uptrust after distribution. Okay, so again, this if we are coming from an uptrend, we have an uptrend, a distribution, and then a reversal. So as we can see here, the pattern is first we will come on a preliminary supply, then the price will reach its peak, its buying climax, and then we will see a deeper pullback, which will reach our previous low before creating a lower high right here. And then once the price showed us a sign of weakness, which is a breakout from this previous two or from our previous low, most of the time the price will likely to make a failed breakout or an uptrust or a spring. And then we can expect for the price to go back inside our range, and then the price will likely to make an uptrust after distribution or the final spring. So we can see that the price is trying to make new high, but every time that the price is trying to break through the climax of the price action, we can see that the price is instantly pulling back on our range. And then once the price reach its UTAD, then this will be the start of the phase C. And once the price entered its phase C, then this is a great opportunity for us to look for a selling opportunity, to look for a selling pattern inside the phase D. And the phase D, this will come the move for another 1, 2, 3 or a new 1, 2, 3 to the downside. Okay, so as we can see, this is happening. If we make this one simpler, this is happening like we came from a downtrend, and then the price created an accumulation pattern or a sideways move, and then the price will show us a spring or a failed breakout, but then it will go back to its range inside the range before creating a reversal. And if you look on our live chart, so we can see that we have a Wyckoff movement here. So here, as we can see, the price came from an uptrend. So as we can see, we have this 1, 2, 3 pattern. We have the 1, 2, 3 pattern here below. Then the price reached its climax, and then as we can see, this pullback is longer. Let me just delete my drawings. So we can see that this pullback is longer than the previous pullback that we have below. Okay. Then as we can see, the price tried to make another push to the upside, and this is the movement that we can see from our drawing. So this is the automatic reaction or the AR. So the AR appeared here, as we can see. Then this is the start of the new high, which is a lower high, right? So if we go back to our drawing, we can see that we have this sample here, right? This buying climax didn't reach, or the reaction, the new move to the upside didn't reach the buying climax. And then as we can see, the price created a sign of weakness here, which breaks the previous low that we have right here. Then after that, the price tried to make another push to the upside, which created a spring or a failed breakout right here, right? So as you can see, this is where our buying climax is. Then the price created a spring or a failed breakout. And then as we can see, after creating its failed breakout, the price started to move lower and the price started to make a reversal. Okay, so that's how we can identify a Wyckoff trading method. And the question now is how we can trade using this strategy. So for example, we are on a downtrend. The downtrend is the opposite of this one. So let's try to look at the downtrend example. So for the downtrend, first we may see a downtrend, a move to the downside, and then the price will create its selling climax right here. Then as we can see, this automatic reaction or this automatic rally has a deeper pullback than our previous pullbacks right here, right? Then as we can see, the price tried to make another move to the downside, but it created a swing, a failed swing, which is a higher low right here. Then the price created a spring or try another breakout to this selling climax that we have right here. Then as we can see, after creating this failed breakout, the price entered the range again. So we have formed a Darvas box right here. So there's we can see the price tried to break this previous low, then the price went back inside the range, and then the price created a spring which entered our phase C. Then after creating this last failed breakout, then this is where the price created a reversal. Okay, so as we can see here, it happened right here. So as we can see, we have a downtrend right here. The price is coming on a downtrend, but after reaching this selling climax, we can see that we have our selling climax here, or we have our lowest point right here. Then the price created a failed breakout right here. The price tried to make another breakout, but after breaking this previous low, the price instantly pulled back inside our range, which is our Darvas box, right? So if we draw it like this, we can see that we have our Darvas box right here. So the price tried to make a continuation to the downside by breaking our selling climax, but the price instantly goes back inside our range, which is the Darvas box. Then as we can see, the price is trying to make another move to the downside right here. And as we can see, the price failed to break our previous low. Then this is where the price started to make a reversal. Okay, so as we can see here, this spring or this second test to break the selling climax or the lowest low isn't always happening. So in that case, we can see something like this. Okay, so as we can see here, the price is on a downtrend. Then we reach our selling climax here. The price created its huge pullback or its long pullback. Then the price tried to make a continuation to the downside, but the price just created a failed swing, which resulted from a higher low. So if this is the case, then we can expect for this one to start once the price created a higher low right here. This is where we can expect the start of a Wyckoff theory or the accumulation phase. Then once we saw that the price is breaking this previous high or the sign of weakness from the downtrend, the price tried to make another breakout, but in this case, we don't see another breakout like this and another pullback inside the range. Instead, what the price did is after creating its failed breakout, the price went inside back the range, and then the price just consolidated inside our Darvas box right here. And this is what happened on this example right here. Okay, So as you can see, the price came from this downtrend. So we have a downtrend here. So after reaching this lowest low, the price created a long pullback. So this pullback is longer than our previous pullback. Then as we can see, the price created a failed breakout, or the price created a spring. Then the price went inside the range again. The price didn't break our previous low. Then as we can see, the price was able to break our previous high right here, which is a sign of a reversal. So in theory, or in the diagram right here, this is what happened, right? So we came from this downtrend, the price tried to make a reversal or a continuation, but the price went inside the range again, and then this is where the price breaks our previous high right here, and this is a sign that the price will likely go up. Okay, so that's how we can identify the Wyckoff theory. So to simplify this again, we can just use this method to make it simpler. Once the price created a consolidation pattern like this, coming from a downtrend, then we can expect that something is happening right here on the accumulation phase, or on the consolidation, the sideways movement. We can see, or we can expect that something is happening right here, or we can expect that this could be the start of accumulation. Okay, then if the price started to make a sideways move or a consolidation movement, so let's say we are on a downtrend, then after reaching this low, then the price created a long pullback. Then after that, the price started to make a consolidation. Once this happened, we should look for a possible reversal. And if the price breaks this previous low, we should avoid trading this breakout, because most of the time this could be a failed breakout, or this could be just a spring, as we can see right here. Okay, so once the price started to make a consolidation move again, we should stop looking to trade the breakout. So if we still want to take a short trade, then we should look for a pullback inside the range, because most of the time the price will break this previous low, and then it will immediately pull back. So if we use a Fibonacci retracement, we can see that we have our golden ratio right here, and this is where the price could make a reaction before reversing to the upside. And if we are on an uptrend, so let's say we are on an uptrend, and then after reaching this highest high, the price started to make a consolidation. So once you saw this, you should start thinking that if the price breaks this previous level, or this previous one that we have right here, we shouldn't look for a breakout trade, because this could be the start of a spring or a distribution phase. Okay, because most of the time the price will start to consolidate first before creating a reversal, just like what we are seeing here on the Wyckoff theory. Okay, so again, once the price breaks this previous one, or this previous high that we have right here, you should stop thinking to buy the breakout, because this could be the start of the spring or the failed breakout. And then once the price went inside the range, so we can draw a box like this. And once the price is creating a pattern like this, then we can expect that the price will go down, or will start a new trend to the downside, which is a reversal pattern. Okay, so that's how we can trade the Wyckoff theory. So as we can see, this is happening a lot of time before making a reversal. So for example, here as we can see, we have an uptrend, right? So the price is creating a healthy correction move right here. But as we can see here, the price started to make its highest point, or its highest high. Then as we can see, the price is failing to break above our resistance level. So if this is happening, then we can expect for the price to make another breakout to the upside. But as you can see in this example, the breakout didn't happen or the spring didn't happen. So of course, this we can expect a movement like this because there's no 100% in trading. But if this is the case, what we can do is to look for a Darvas box right here. Okay. Once we identified the swing high and the swing low, we can draw a Darvas box. Then as we can see, after the price started to make a consolidation right here. So let's just say that we are just right here. So after the price created a consolidation pattern around this level, we can see that the price is now creating a lower high. So this is also a good combination. As we can see from our drawing right here, the price, once the price started to make a consolidation inside this range, the price will likely move or will likely create a lower high before starting to go down. Okay, so as you can see, that's what really happened right here. The price started to make a consolidation right here. Then as you can see, after consolidating around this level, the price started to make a lower high and a lower low right here. So we have lower lows while having lower highs. So this is also a channel if you remember our webinar about channels and trend lines. So what we can do here is to wait reversal pattern, which is a 1, 2, 3 pattern to the downside. Again, we came from an uptrend. Then after reaching this highest high, instead of making a new high, the price just consolidated around this level. And then the price started to create lower highs and lows. Then if we play this, we can see that the price is now struggling to break this new high that we have right here. And we can see that the price started to break its low, its new low, recent low right here. And if you are a breakout trader, you may look for a breakout trade with this breakout candle. Or if you are a pullback trader, then you should look for a pullback from this previous support. And if we forward the chart, we can see that, as we can see, the price is still trying to go back inside the range, but we can see that the price is still creating a lower highs right here. The price still can't reach this previous high that we have above here. So this is a strong sign that the price is will likely to go down. And if we continue, so we can see we have another breakout from this recent low, and the price started to create a build up right here. So this is what we can also call a breakout build up. So once the price started to show us a movement like this, as we can see, the price is consistently making a lower highs like this. So this is what we can also call a breakout build up. Okay, once you saw that the price is doing this pattern, then the likelihood for the breakout to succeed is stronger, or there's a huge likelihood for the breakout to be successful. Then as we can see, if we forward our chart, we can see that the price tried to make another push again to the upside. So there's a lot of volatility from this market. But as we can see, the price can keep up with the momentum to the upside. And finally, the price started to reverse. Okay, so this is what we need to consider if we want to look for a Wyckoff theory, or if we want to trade the Wyckoff theory. Okay, So again, as we can see, we came from this uptrend. We came from this uptrend. Then after reaching this highest high, so of course we won't know if the price will create its highest high or if the price is now sitting on its highest high. We don't know that. But if the price started to make a consolidation like this, and then if the price started to make lower highs and lows, such as this one, then we should start looking for a possible reversal. Okay? And if we look for more example, so let's try to look for another example. So as we can see, we have another good example right here. So we came from this uptrend. So we have an uptrend right here. But then as we can see, the price created a long pullback right here. And the price also was able to break its previous low. So this is a sign of weakness. So as we can see here, this is a sign of weakness. Then the price tried to make another push to the upside. So this is our peak or the buying climax. As we can see, the price tried to make another breakout to its climax or to its highest high. But then as we can see, this is just a spring or this is just a failed breakout, or this is what I am trying to say earlier. If you saw that the price is starting to make a sign of weakness and a consolidation right here like this, then if the price breaks its previous high, then the likelihood for the breakout to succeed is low because this could be the start of a spring or the failed breakout. Then as we can see here, after creating its failed breakout, the price entered its phase C, then finally the reversal. Okay, so then as we can see, the price is consistently making lower highs right here, just like what we have from our previous example. Okay, then as we can see, after creating these patterns, the price break its previous lows right here, and this is where the price started to make another 1, 2, 3 pattern to the downside. Then as you can see, after having a Wyckoff movement or a Wyckoff strategy above here, once the price goes down, we can see that the price consolidate again right here. So we have a downtrend right here. Then as we can see, the price started to make another huge pullback again or a long pullback again. We even broke this previous high, which is a sign of strength, a sign of a strength that the price may likely reverse. Then as we can see, we have another spring right here, which is a failed breakout. After breaking this previous low, the price went back up inside the range again. Then as we can see, once the price started to make a spring right here or a failed breakout, the price is now starting to create a higher low, which is a sign that the price will go up right here. Okay, and then the final thing that we need to remember is we need to see a break of a structure or a change of character, which is a breakout from this most recent high or our recent lower high. Okay, so combining all of these things together, we can see that we can have or we can avoid trading the failed breakout, or we can avoid trading the mature trend if we learn how to use the Wyckoff trading methodology. Okay, then as we can see, we have another push to or we have another pattern right here. So we are on an uptrend right here. Then as we can see, after reaching this level, this high right here, the price started to make another long pullback, which breaks the previous low that we have right here. So this again is a sign of weakness. Then as we can see, the price couldn't even make a spring above here. So the price couldn't even make a spring like this, but instead the price just consolidated right here. And then as we can see, the price started to create a lower high right here. So the price even tried to make another breakout to the upside, but the momentum can keep up. And then we can see that the price created a complete reversal. Okay, so that's how we can trade the Wyckoff theory. So again, what we should remember is if we are on an uptrend and then the price first, we should look for a pullback. If the price created a long pullback like this, which reached its previous low, then this could be the start of the distribution phase. And then if the price started to make a consolidation, we should look on our previous high. And then if the price tried to break this previous level, we can expect that this is just a failed breakout, or this could be just a spring because we came from a consolidation. And then we can expect that the next thing would happen is for the price to create a lower high like this. Then after breaking this previous low that we have right here, again, we can draw a box for us to see it clearly. Once the price breaks our box, the bottom of the box, then we can expect for the price to create or to make a complete reversal. So that's the pattern if we are coming from an uptrend. Then if we are coming from a downtrend, so let's say the price created a huge or a long pullback, then we can expect that this could be our high and then this could be our low. Then once the price started to make a consolidation inside this range, we should avoid trading the breakout because this could be a spring or this could be a failed breakout. So after seeing that the price is trying to break through this previous low, then we should expect or we can expect that the price will create a higher low right here, like this one. And then once the price breaks this previous high, again, we can draw a box like this. Once the price breaks the top of the box, then we can expect for the price to make a complete reversal to the upside. All right, so that's how we can trade the Wyckoff methodology. All right, so if we analyze the pound dollar today, as we can see, we are on a daily time frame. So we have an uptrend right here. The price started to make an uptrend after reaching this low. The price started to make a reversal, and then if we analyze this one today, we can see that the price is trying to make, or the price is about to make a consolidation, or we are already in a consolidation phase right now. So we can expect that the price of the pound dollar could go down because we are now seeing first long pullback. So this long pullback was able to break our previous low right here, and this is a sign of weakness. And as we can see, the price tried to make a push again to the upside, but we don't have a spring yet. So we can expect for the price to make a spring or a breakout from its previous high right here. But again, this breakout can be a failed breakout. It could be a failed breakout, and we should avoid trading breakouts if this is the case. Okay, then after, so let's say the price created a spring, then the next thing that we should look is for the price to create a lower high and finally a breakout from this low that we have right here. So once this happened, then we can expect for the price to continue going down again. All right, and as we can see, this Wyckoff trading strategy is also happening around here from its resistance zone. So combining all of these things together, we can see that the price is now starting to make a consolidation. So we can expect that Wyckoff theory is happening right now for the pound dollar. So again, what we should or what we can expect is for the price to create a spring or a failed breakout right here. Then once the price went back inside our range, then we should look for a lower high or even a possible failed breakout again before creating a lower high like this. And then once the price breaks this previous low or the bottom of our box, then this could be the start of a new downtrend or a new downtrend. All right. So that's how we can use the Wyckoff trading methodology. All right. So for our next point, what we have is the Elliott Wave theory. So for the Elliott Wave theory, this one is a technical analysis that looks for recurrent long-term price patterns related to persistent changes in investor sentiment and psychology. So this one will include something of a fundamental analysis. So if you are trading the price action, if you are looking for uh, price patterns, then you can include fundamentals if you want to trade Elliott wave. And this theory identifies impulse waves and the setup pattern and corrective waves that oppose the larger trend. And there are three rules for identifying Elliott wave. So first, the wave 2 should never moves beyond the start of the wave 1. All right. So again, we already know the 1 2 3 pattern, but to if you want to trade Elliott wave theory, all you need to do is to continue counting the 1 2 3 pattern up to 1 2 3 4 5. Okay? Once the price reach its fifth wave, so again this is our 1 2 3 and 4 and fifth wave. So the Elliott wave theory is saying that once the price reach its fifth wave, this could be the start of the the end, or this could be the the end of the uptrend, and we can expect for the price to create a reversal once the price reach its fifth wave. And the second rule is the wave 3 is never should never be the shortest wave. And the third rule is wave 4 should never enters the price territory of wave 1. So if we look on the live chart, let's try to look at the euro dollar. So this is what an Elliott wave theory looks like. Again, from our three rules, wave 2 never moves beyond the start of wave 1. So it is saying that this is again the wave 1, and then it says that wave 2 never moves beyond the start of wave 1. So the wave 2 right here should never break the wave 1 or the low of the break of the wave 1, because if the wave 2 breaks this level, then the Elliott wave theory is invalidated. Okay, and if we look on this example, we can see that we have example 1 right here. Do you think this is a valid Elliott wave theory? So this is our 1 and this is our 2, 3, 4, 5. So the second wave breaks our previous level or our previous wave, which is the wave 1. Do you think this is still a valid Elliott wave theory? Okay, so to continue, the wave or the rule 2 or the second rule is wave 3 is never the shortest wave, or wave 3 should never be the shortest wave. So if we have a wave 1, wave 2, and then if we have a wave 3, so the yes, just chilling is right. It is not a valid Elliott wave theory. This example right here is not a valid Elliott wave theory because as we can see, the wave 2 breaks this wave 1, right? Or the low of this wave 1. Okay? And then again, the second rule, let me try to copy this one. So here, this is better. So here, as we can see, the wave 3, for our rule 2, it says the wave 3 should never be the shortest wave. As we can see, if we are looking for an Elliott wave pattern, again the wave 2 again should never touch or never pass beyond the wave 1, which is right here. And then the rule 2 that we have right here says that wave 3 should never be the shortest wave. So that means wave 3 should be the longest wave. Okay? And then once this wave 3 is completed, our next rule is wave 4 should never enters the price territory of wave 1. So the price territory of wave 1 is right here, right? So it says that wave 4, so this is our 1, 2, 3, and this is now our wave 4, right? So as we can see here, the rule says that the wave 4 should never enter the price territory of wave 1. So the price territory of wave 1 is right here. So if you remember our 1, 2, 3 pattern, we are expecting for the price to pull back inside our previous one, right? But in Elliott Wave Theory, we are expecting, or we should see the wave 4 or the pullback to never enter the previous resistance or the previous one. Once the price reach our previous one, right, like that, then this is not a valid Elliott Wave Theory anymore. Okay? So what we can, or what we should look is for the price to create its wave 4 that will never reach the previous one that we have right here. So this is the final rule. Then once the price created its fifth wave, then we can expect that this fifth wave could be the start of our reversal or the start of a move that's something like this. And if we are on a downtrend, so the opposite is true. So we should look for a pattern like this. So this is our first wave. Our second wave didn't breaks our the low of our wave 1. Then we have the longest wave, which is our wave 3. And then as we can see, our wave 4 right here didn't reach our previous one. And then the price continued to go down to complete its fifth wave. And then as we can see, we have 1, 2, 3, 4, 5 wave. And this, according to Elliott, this could be the start of a new trend to the upside once the fifth wave is completed. Okay. So if you look on our examples, so here as you can see, the example 2 is we have a 1, 2 wave, and then we have the third wave, but this third wave is short, right? So according to our rule, we should see that the wave 3 is never the shortest, or the wave 3 should never be the shortest wave. So in this example, we can see that the third wave is the shortest wave compared to this wave 1 and wave 5 right here, right? So if this is the case, then this example 2 isn't valid, example 1 isn't valid as well. And if we look on our next example, so let's just mark this one. And if we look on our next example, let me know what do you think if this is a valid Elliott wave. So we have our wave 1 and then we have our wave 2, and wave 2 didn't reach the low of the wave 1. And then as we can see, the wave 3 is long. And then we can see that the wave 4 didn't reach our previous one right here. And then finally, the wave completes its fifth wave. So do you think this is a good example of an Elliott wave theory? And then finally here, we have an example 4. So we have wave 1, wave 2. The wave 2 didn't reach the low of the wave 1 again. And then we have our wave 3. And the wave 3 is long. But as we can see, the wave 4 went back down from our previous one. So do you think example 4 is a good Elliott wave theory? And then finally, we the wave 5 is completed right here. So do you think example 3 is the perfect example for the Elliott wave, or the example 4 is the perfect example? What do you think? Yeah, Venancio Junior Arenas is right. Example 4 isn't valid. Okay, so as we can see, we can combine the Elliott Wave theory and the Wyckoff trading methodology, right? Because for example, we are on an uptrend. So let's say we have a move like this. So this is an Elliott Wave. So again, the second wave didn't reach the low of the previous one, and then the third wave is long. Then the fourth wave didn't reach our previous one right here before finally completing at our fifth wave. So if this is the case, we can expect that a reversal will uh, will will come, or the reversal may come after the fifth wave because the Elliott wave theory is completed. So if this is the case, then we can expect for the price to make its Wyckoff theory, or the Wyckoff trading methodology will come after this fifth wave. So after seeing that the Elliott wave theory is completed, then we can expect for the price to Elliott says that this theory, or the fifth wave, is the last wave for the uptrend. If that is true, and if that is the case, then we can expect that from this wave, from this fifth wave, this could be the start of the Wyckoff trading methodology. And once we saw that the price is creating some sign of weakness, which is a breakout from our low, and then if the price created a consolidation and then a spring before creating a lower highs and lows right here, then we can combine the Elliott wave theory as well as the Wyckoff trading methodology right here. Okay? So if you want to trade reversal, Elliott wave theory and Wyckoff methodology is your best trading strategy for you to see or to look for the sign of weakness on a trend. As well as we can also use some technical indicators such as RSI to look for divergences, because we can combine divergence right here. So let's say, for example, we can see that the price created its Wyckoff methodology here. Then if the price created a spring, we can see that we have a higher high right here. Then let's say that the RSI is creating a lower high. Then this is a divergence, and we can combine all of these things together, which could lead us to a more profitable trading strategy. So if you combine the price action together with your indicator, then your probability of winning the trade could go higher, right? And again, what we can do here, if we are trading the Elliott wave theory as well as the Wyckoff methodology, again, what we should do is to look for the breakout of our box, then look for pullbacks or breakouts for a possible move to the downside. And if we are on a downtrend, then the opposite is true for that one. So let's say we have an Elliott wave theory to the downside. So we can see that the price, the wave 1 didn't reach our low, or the wave 2 didn't reach the low of the wave 1, then the wave 3 is long, the wave 4 didn't reach our previous one, then finally the fifth wave completed right here. Then as we can see, if let's say the Wyckoff methodology entered after the fifth wave, then what we can expect is for the price to create a spring. And then if we can see that the price is creating a lower low while the RSI is creating a higher low right here, then we can expect that the price will make a reversal. Then again, what we can do is to look for a sign of strength, which is a higher low, and then finally the breakout of our box right here. Then we can look for pullback. We can also use our Fibonacci retracement for a possible pullback inside the range for a possible continuation to the upside for the completion of our Elliott wave and the Wyckoff theory. Okay, so let's try to look on our live chart if we can spot an Elliott wave theory. So again, always remember that there's no 100% in trading. Even if you are seeing that we have a complete 5 waves, but if the price is still creating new lows and highs like this, then the downtrend is still strong, or the momentum of the the sellers are still stronger than the buyers. Okay, because that's what happened right here on the euro dollar. So as we can see, we have so much waves right here, which created an Elliott Wave jury because it created 1, 2, 3, 4, 5 waves, and then we have another 1, 2, 3, 4, 5 waves, and then we have another 1, 2, 3, 4, 5 wave here. Then finally, as we can see here, the price created its final 5 waves. So here 1, 2, 3, 4, 5. Then as you can see, after creating this Elliott wave waves, or this fifth wave, after creating its fifth wave, we can see that the price is now showing us some weakness, and this is also a good indication that the price is likely to go up, because we can see that after creating lower highs and lows right here, the price is continually making lower highs and lows. Then after completing its Elliott wave jury, the price can't break its low right here. So instead of breaking its low, and then if instead of creating a continuation to the downside, what the price did is the price created a higher low. So this is now a sign that the price is making, or this is a sign that the price will make a reversal. Then as we can see, the price created another push to the upside and then another higher low before finally breaking its structure, or its previous high is its recent lower high right here. And we can also draw a box like this, and this is also a form of a Wyckoff theory. Okay, but this Wyckoff theory didn't make a spring, so sometimes it's happening. But as you can see, we still have our breakup structure, or the change of character still exists. Then as we can see, finally the price created a reversal. And if we analyze euro dollar today, we can see that we have another 5 waves starting from this level up to this level. So we have another 1, 2, 3, 4, 5 waves. So assuming that the price will make a reversal right now, then we can expect that the price could make a consolidation like this and then a spring before finally creating a reversal to the downside. And this is happening, this Elliott wave jury is also happening from our resistance zone above here. As we can see, we can combine all of the things that we learned from our past webinars. We can combine all of the things that we learned to make an informed decision whether we want to trade a continuation or a reversal. So, judging by the price action that the euro dollar is doing now, do you still want to trade continuation, or are you already looking for a possible reversal to the downside? If you ask me, of course, we have a complete Elliott wave theory here. As we can see, this wave 4 didn't reach our previous one. Then the price finally completed its fifth wave right here. And it is happening at exactly our resistance zone right here. And if this is the case, we know that the price will likely to go down if the price started to consolidate around this resistance level. So if the price uh, started to consolidate like this, then we can expect for a possible reversal. So if you are trading, or if you have a position on the euro dollar right now, then if the price started to make a consolidation, then you may want to unload some of your position. Okay? Don't close all of your position, because we can still see a possible continuation to the upside. But if the price, instead of making a continuation, let's say the price started to make a consolidation like this, then the likelihood for the price to continue is lower. Okay, and again, what we can do to look for a Wyckoff strategy is to look for this previous low. Once the price breaks this one, this is a sign of weakness. Then we can expect that a consolidation will likely to happen. All right, and we can also combine multiple time frame analysis on our Elliott Wave theory. So for example, we have a 1, 2, 3 pattern. So of course, we are expecting for the price to pull back on our support level. So for example, we have a daily time frame, or we are analyzing a daily time frame, and this pattern appeared, the 1, 2, 3 pattern appeared. Inside our lower time frame, we can expect that Elliott Wave theory is also happening right here. And then we all know, right? We all know that the price has a tendency to pull back. And then inside our lower time frame, once you saw that the Elliott Wave theory was completed, then we can expect that the pullback is likely to happen after the Elliott Wave theory was completed right here inside our lower time frame. So if you saw that on your lower time frame, Elliott Wave theory is happening, then and as well as it is also the third wave, then we can expect that the pullback will happen and we can look for a possible entry inside our lower time frame. Okay, so that's how we can combine the higher and lower time frame if we want to trade the Elliott Wave theory. And if we apply it on the euro dollar right now, we can see that we have this 1, 2, 3 pattern. Then the price pull back on our previous resistance, and this impulsive move, which is this third wave from our 1, 2, 3. If we go down on our 1 hour chart, which is our entry time frame, we can see that we have an Elliott Wave theory appearing here or happening right here. So we can see that we have 1, 2, 3, 4, 5. Then the price created another 1, 2, 3, 1, 2, 3, 4, 5 move here. So that's the completion of our Elliott Wave theory. Then as we can see, the price started to create a Wyckoff theory here. So again, if we draw our Elliott Wave 1, 2, 3, 4, 5, then as we can see, the price started to consolidate around this level. So this is the combination of Elliott Wave and the Wyckoff theory. Okay, and as we can see, we have a long spring right here. Then finally, the price started to pull back. So this pullback right here is just the pullback from our daily time frame. Okay. So right now we are on our support, and if we analyze euro dollar right now, we can see that we again have an Elliott Wave theory here. So this is our 1, 2, 3, 4, 5 wave. Then after completing the fifth wave, we can see that the price started to create another Wyckoff methodology, or the Wyckoff appeared again right here. As we can see, the price created a sign of strength. The price breaks this previous high. Then the price started to consolidate, and then we saw that the price created a spring right here before finally creating its first higher low and its first higher high right here. So what we can expect for this one is for the price to make a complete reversal for a possible continuation to the upside on our daily time frame once the price breaks its previous high right here. So assuming that the price, so let's say the price was able to break its previous high right here. So again, we are seeing Wyckoff theory after completing its Elliott wave. And this is the pullback from our daily time frame. So let's say the price breaks this previous high. So what we can do to look for, or what we can do to look for a possible entry to the upside. So for us to look for an entry, what we can do is to look for a pullback. If the price entered the range again, this Darvas box, we can use our Fibonacci. And then if we saw that the price or the golden Fibonacci zone is sitting right here, then we can expect for the price to make a reaction into this level for a possible continuation to the upside, which is the continuation from our daily time frame. Okay, so as we can see, that's how we can combine Elliott Wave, Wyckoff theory, as well as the Darvas box and the price action patterns and the Fibonacci retracement. All right, so to recap, what we learned is the Wyckoff theory. It has three phases. The phase one is if we are coming from a downtrend, it will create an accumulation. And then after the accumulation, reversal will happen. Then after the reversal was end or after the uptrend ends, we can expect to see a distribution and then another possible reversal. And if we go back to our drawing here, we can see that the cycle of the chart is just like this. So first we have accumulation phase. So this is where a lot of investors and a lot of traders are afraid to buy because the price is going down. Then after the accumulation phase, the price will now start to go up. Then this is where a lot of investors will buy. And then after reaching its peak, we can expect or we can see that the price will enter its distribution phase, and a lot of traders and a lot of investors will be hyped when once the price reach its peak or it's nearing its peak. And if you remember, this is what happened on Bitcoin last December 2017, right? Prior to 2017, no one is no one is trading or investing in Bitcoin, right? No one is paying attention on Bitcoin. But once December 2017 arrived, a lot of investors were hyped and they bought near the distribution phase of Bitcoin. And then after that, after the distribution has ended, then another phase will come, and this is the markdown or the start of the reversal. So as we can see, this is just the cycle of the market, any market that we trade. Those patterns are always happening. So as we can see here, we have a downtrend. Then we can see that the price created its accumulation phase right here. And then we can see that the price is now trying to go up. So let's say the price reached this previous high. Then the price created its distribution phase. Then we can expect for the price to make another downtrend or to enter a new trend which is down. Okay, so as you can see, that's the cycle of any market. So and if we look on the Bitcoin, so we can see that on December 2017, just like what I am trying to say earlier, so this is what happened on Bitcoin last 2017. So around this time, no one is paying attention on Bitcoin. But when the price started to go up, this is where the price started to make its noise in the market. Then as we can see, the price started to reach its peak. Then the price started to make a long pullback. So I know that you know what's next. What will be the next thing to this one? The price breaks its previous low, and this is a sign of weakness. The price didn't even created a spring, and as we can see, if we draw a box, the price was able to break its low, and then this is where the price started to make a reversal. And after December 2017, the price of the Bitcoin went down up to this level. So after creating a Darvas box right here, then after breaking the bottom of the box, and we can see that the price of the Bitcoin fell down up to this level. Okay, so as we can see, that's just the normal cycle of the market. We have uh, an uptrend, then we have a distribution, then we have downtrend, accumulation, another movement to the upside, and then another distribution, and then another downtrend, and then another accumulation, and then another uptrend. So that's just how the market works. This is just the cycle of the market. So that is why it's very important to learn this theory or to learn this methodology for us to be able to avoid trading against the trend or trading when the trend is likely to come to its end. Okay? So having said all of those things, you may now ask some question. So if you have some question, you can ask on our live chat before I ask you my question for today. Okay? And by the way, I would like to encourage you again to please be with us up to Friday. So today is the second to the last webinar that we have from this series. And come Friday, it will be our last webinar for this series. And the OctaFX team will give you certificate, and then they will give you the chance to have 100% bonus, and you still have two chances to win the $100 on your trading account. And we are pretty sure that after the webinar you will have your own action plan or your own trading plan. If you trade using the tools that we learned so far, I am pretty sure that you already know how to look for the trend, how to look for structure, how to look for the patterns, and when to buy and when to sell. And of course, to I want to make a reminder to every one of you to uh, please register on this link for you to get the training certificate. Okay, so I will paste the link on our live chat. So one moment, please. If you haven't done it yet, please register on this link. So there, I sent it on our chat box. And of course, I want to invite every one of you again to please join the this event. So let me just log in. Hello, Dream Home Reality. Later, we will try to look at the gold, if what's happening on the gold right now. So while waiting for this one, let's try to look it. Let's try to look at what's happening on the gold right now. So as we can see, we have some drawings here on the gold. So if we analyze gold today, we can see that we have a breakout from this previous resistance. So we can expect that this resistance could act as a new support, but as we can see, the price breached it. The price breached this previous resistance that may turn to support. So if this is the case, you know what to do. We should pull out our Fibonacci retracement, and we can expect for the gold to come back down here between 1775.970 and 1815.111. So this is where we can expect for the price to drop. The price could pull back into this level before continuing to go up. And as we can see, we also have 1, 2, 3, 4 pattern, and this could be the start of the Elliott Wave. So as we can see, the wave 2, wave 2 didn't reach its wave 1. Then the wave 4, if the wave 4 can't reach this wave 1, then we can expect that the fifth wave could be the last wave for the gold. And as we can see, we also have some levels of structures here which could act as a resistance. Okay, so that's how we can analyze, or that's what we can expect for gold on the coming days. Hello, home sweet home. Thank you for your sweet message, and thank you for always watching our webinar. Hello, Shailendra at 99. Sure, I will try to paste the link again. You are very much welcome, Kev Martinez. Let me try to paste the link again. So just give me one moment, please. I think YouTube isn't allowing us to paste a link on the live chat. But if you want to have access on this link, all you have to do is to subscribe or be part of our Telegram channel. You will see this link inside that channel. Sorry about that. YouTube isn't allowing us to paste links inside their live chat. I don't know why, but that's their rule. Okay, so any question before we proceed on my question for you today? Hello, Sir Venancio Junior Arenas. I am encouraging you to please take a look on our website for you to be able to copy trade. You are very much welcome, Dream Home Reality. Hello, Diamond. Yes, you may trade this theory or this methodology on any time frame. You are very much welcome, Erica. Hello to you too, Muhammad Faisal. Hello, Andy Buesa. I'm sorry, but I don't have any experience with trading EA, with trading bots. Hello, Nelisa Ambalong. You are very much welcome, and I would like to invite you to please watch our whole webinar series for you to be able to learn more, especially if you are just beginning on your trading journey. So, on our final webinar on Friday, we are going to talk about on how to make uh, an entry. The Of course, I know that I already taught you on how to make an entry from our past webinars, but on Friday, we will include the fundamental and technical analysis if we want to make an entry trade, I mean. And I am also teach you on how to look for the most objective way for you to be able to locate your right placement for your stop loss. So please watch out for that webinar. That will be our final webinar for this series. And if you want to have more webinar series with me, please click like and share, and of course subscribe on our YouTube channel. Hello, Shailendra at 99. If you want to see the link again, I am encouraging all of you to please subscribe or be part of our Telegram channel because YouTube isn't showing the links on their live chat. So I don't know why, but maybe that's their rule. Hello, Johnny De Vera Mangandi. So if you are a first timer, again, I am encouraging you to please watch our entire webinar series beginning on the lesson one for you to have a more deeper knowledge on what is Forex and how to trade using price action. Hello, Nelisa Ambalong. The Telegram link could be found on the description box below. Hello, Abdullah. Nice question. If you have a 1, 2, 3 pattern, so let's say you have a 1, 2, 3 pattern, then the price breaks this previous 2 or the previous low. So this is what we call the break of structure or change of character. So if this happens, then the uptrend will likely to come to an end, or the uptrend is losing its steam, and we can expect for the price to make a possible reversal because this previous two uh, should we should always remember that this is the last low that keeps the trend to go up, or this is the last low which is keeping the trend uh, to still continue. But if the price breaks this low, this last low, then the uptrend is already losing its steam. And the same goes true for the downtrend. Once the price breaks this previous high, then the downtrend will likely to come to an end. Okay? You are very much welcome, Raver Montoya, as well as Johnny De Vera Mangandi. Hello, Home Sweet Home. If you want more webinars with me, again, I would like to encourage you to please like and share this video and subscribe on our YouTube channel. Hello, Andy Buesa. You can identify majority swing highs and lows using the 1, 2, 3 pattern. So we already talked about that from our previous webinars. So you may want to rewatch it if you haven't done it yet. Hello, Dayoshioye. Wyckoff theory is likely to appear on the fifth wave on the Elliott Wave theory if we combine those two theories. But even if the Elliott Wave theory isn't finished yet, we can still see Wyckoff theory is happening. As long as the price is started to create, so let's say we are on an uptrend, we only have 1, 2, 3 pattern, but the price is started to make a long pullback and then it started to make a consolidation. This could be the start of the Wyckoff theory, and if the price created a spring, avoid trading the breakout. Instead, look for a possible pullback because the price has a tendency to make another push to the upside, or better, to don't trade long trades from this pattern. Instead, just look for a possible breakout from this previous low for a possible reversal. Okay. Hello, Usama Bashir. Resistance, which is turning into support, is also important. So let's say, for example, we have this 1, 2, 3 pattern. We already know that this previous resistance could act as a support, right? Once the price pull back into this level, we can start looking for a possible long trades because we can expect that the price could go up for a possible continuation to the prevailing trend. Okay, but we can also we must also take a look at our previous low, which is our previous two, because this low right here is also important because once the price breach it, then the uptrend will likely to come to an end. Okay, so this both structure right here, which is the previous one and the previous two, is both important, and we should take a look first, of course, on our previous one and our previous two down below here. Okay, I hope I was able to ask your question correctly. Hello, June Kaintik. You can watch the previous webinar on our YouTube channel. By the way, OctaFX released their first episode of Usapang Forex, and this is suitable for us Filipino traders because it is on Tagalog. So if you haven't seen it yet, so here this is the first episode of our podcast, the first episode of the OctaFX podcast. I mean, you may want to look into it. So there, as we can see, and our second episode for this podcast, I think it will be next week. Hello, God's time. Yes, you may also trade 1 hour and 5 minute time frame. Hello, Abdullah. That is a pretty much, or that question is pretty, what do you call it? So let's say, for example, it is pretty subjective. So let's say the price started to pull back. Other traders are saying that once they saw three red candles, they will consider it a pullback. But on my experience, I am just looking for my previous resistance to become support. Then once the price pull back into it, then that's the only time for me to look for a buying opportunity. As long as the price isn't touching my support, so let's say the price just pulled back right like this without reaching the support, then I will not look for a trade because this could be the start of the Elliott Wave theory. Okay, but you can still trade the breakout. So let's say, for example, the price didn't reach the support, but instead breaks this previous high, then we can trade the breakout. Okay. All right. Any question? Okay. So if you don't have any question, let's now move on for my today's question, which is it is a form of technical analysis that looks for recurrent long-term price patterns related to persistent changes in investor sentiment and psychology. The theory identifies impulse waves that set up a pattern and corrective waves that oppose the larger trend. So the answer to this one starts with letter E. Okay, so you may now start answering. And don't forget to put your trading account number, your live trading account number, together with your answers. Oh, you took? Yes, your answer is now recorded. You are very much welcome, God's time. Hello, Vincent Liagas. You may look or you may want to look for our next lesson on our YouTube channel. Thank you for tuning in with us as well, John Michael Mendoza. See you on Friday for our final webinar for this webinar trading series. And again, if you want to have more trading webinar series with me, I would like to invite you to please join our Telegram channel and like and share this video. And of course, subscribe on our YouTube channel. All right, so that will be our webinar for today. So thank you everyone again for tuning in for today's webinar. So once again, this is Paul Mendoza, your trading speaker. See you again on Friday for our next live webinar. Bye.